Hello, very excited to be here, and we've convened a wonderful group to carry us through this panel. So without further ado, as they take their seats, I will ask them to introduce themselves. Jeremy, maybe if you want to start with you and move down the line.
Hello, my name is Jeremy Beaudry. I'm the head of financial crimes at Unit 21. Served as compliance officer at several different fintechs before joining Unit 21. Thank you very much for having me here.
Hello, I'm Trish Sullivan. I'm the global head of financial crime and compliance, business control, and oversight at Deutsche Bank.
Hi, I'm James Shaw. I'm from Scotiabank. I'm the enterprise head of anti-bribery and corruption. I'm the global head of financial crimes for global banking markets and the enterprise head of transaction monitoring.
Hi, okay, yeah, it's working. Hi, I'm Madhunadik. I'm the co-founder and CTO of FlagRide. Yeah, great to be here, thank you.
Excellent. Before we get started, just a reminder to the audience, you can submit questions via the Brella app. So please do so. We will have a robust Q&A towards the end of this panel. So to first kick things off, our very first question is, what are the most significant forms of financial crime that are emerging as threats to FIs today? So James, I don't know if you want to kick us off.
Yep, I'll start with that. So again, this is very loaded by the fact that I'm in the global banking market space. But for me, some of the largest new threats are the new payment channels. Okay, we're moving to real-time rails. We're moving to a lot more access, sort of financial inclusion, which means we've got a lot more high-risk jurisdictions involved. There's less touch points for entities that are sort of regulated like financial institutions are. There's more MSB access, and that introduces a lot more risk. I'm seeing that across the footprint at Scotiabank, especially sort of in the Middle East. We're seeing that there's a lot more access, shall we say, to rural areas, which is the good thing to do. But what it does mean is we've got to be even sort of tighter on our controls. So I'm seeing a lot of that, and also again, sort of identity theft and that sort of thing is a big part now. Since COVID, that's actually increased a lot more.
Trish, anything you want to add on there?
So one of the things we're really focusing on is sanctions evasion, and given the war in Russia and Ukraine, how parallel import channels are being used to potentially evade sanctions. Also, I don't know if anyone attended yesterday's IIB AML conference, but U.S. Treasury was also speaking about this risk, how this is a very real risk, and how goods are making their way to Russia through financial institutions related to sanctions evasion. And also, I think another risk to highlight is external fraud, definitely on the increase, whether it be impacting our clients and having transactions executed through the bank, or cyber intrusions. And I think those are both great topics for RegTech solutions.
So an excellent segue. Speaking of fraud, our next question is, what measures can firms take to enhance their fraud detection and investigation processes? So Jeremy, I don't know if you want to take this.
Sure. So a lot of the times whenever banks start off with fraud detection is they are already in a pretty complex case, especially as larger banks start doing acquisitions, mergers, new product launches. A lot of the data that corresponds with either that merger and acquisition or product stays within that area. So you end up having a lot of data silos that end up being created, whether you like them or not. And there's also new fraud typologies that maybe you're not collecting certain amounts of data. So you either have the siloed data within all those separate instances, and then data that you're not collecting, or you are collecting, but you're not using it to leverage for fraud purposes. And that presents an opportunity for banks to change the way that they're thinking of things. So being able to leverage all of the great data that you are collecting in one unified fashion, being able to look at customer life cycle at onboarding, but through the way that they're transacting, but also event-based data that's non-transactional in nature. That's just kind of one way that banks and other FIs can start identifying fraud to prevent it from occurring, which can have reputational issues relating to the bank, but also, since social media is so popular, a one takeoff of a scam or fraud can certainly make your social media marketing team work over the weekends just to do damage control.
And Madhu, I know you have some thoughts.
Oh yeah, I think one of the things that's often overlooked is like the investigative tooling that comes with, financial crime prevention. Like when there's an alert or when there's like a flag, that's only the start of your operational life cycle of how you deal with that. And as Jeremy mentioned, there's like a lot of silos. There's like disparate data sources. So internal analysts or persons investigating these alerts, they usually look at 5 different screens, 5 different toolkits. Different data warehouses, even in some cases. So there's actually no clear log of like, what investigation actually took place. Like if you go back to the same alert 3 months after the fact, narrative, case closure and all that stuff will capture some of it, but you don't really get a clear idea of what was actually checked, what was actually investigated. And it impacts in several ways. One is obviously like, operational inefficiency, because now, with this kind of disparate infrastructure behind it, it takes much longer than it actually should to actually dispose a case or to actually, find patterns there. And secondly, it's much harder for this to relate back to downstream, right? Because people investigating the case or an alert, they might actually find new patterns, new typologies, and now it gets much harder to, if there's no centralized way to track it or like a centralized tool to perform these investigations, it's much harder for it to have like a downstream effect of like, now having newer controls to prevent things that you're seeing now. So that then you have like a much larger window where you can be hit harder because you're just taking much longer to react to new forms of fraud and financial crime attempts.
Shloka, can I go off piste a little bit? Everyone's going to get a little bit worried here. We've got 2 vendors on the stage here, and we've got 2 institutions. So one issue, and Jeremy, you mentioned this, about the fact of organic growth and having lots of different systems. And for a long time, and we're guilty of that at Scotia, we've got 33 countries. Have we, and I would like to know, is there a universal adapter? Because it's one of the issues I find is a lot of solutions we get need to be coded into a particular thing, FCDM for Oracle, those sort of things. Is there anything on the horizon that means that we can actually sort of have all those disparate systems that may have different data to bring it together into one solution?
Well, I mean, in a perfect world, I think that would probably be a good approach. But I think that when you have, unless you believe in only 5, maybe 1 centralized system that's going to do all transactions, that could possibly be achieved. But ultimately, as you have separate financial institutions that care about certain or different data, or they have it architectured in a certain way, I think it would be very challenging. But I think that ultimately, it's whatever solution needs to be flexible enough to take in the data and make it representative of what you're trying to prevent. And so I think it's really on the vendor solution that you end up selecting that has the ability or flexibility of incorporating data that is maybe outside of the typical norm.
Thank you.
And also, I know that we've talked more about data and tooling, but Trish, you also had some insights around sort of staff awareness when we talk about this piece.
Yeah, I think a lot of times if you're in a financial crime compliance function, you're always thinking about what kind of tooling you need to monitor your payments related to potential fraud risk and helping protect your clients. But I think a really material risk also is the risk our own staff present in terms of making sure they employ the right hygiene when engaging with incoming messages and things like that, so that we don't expose our client data, our bank rails, to external cyber fraudsters. And I think sometimes if you're in the financial crime world, you leave that maybe to the cybersecurity people and you don't really think of it as your problem. But it really is a key fraud risk. And we've recently run, some of the phishing scams of, across our own staff, and the percentages of people that, actually fall into some of the traps are really incredibly high. I recently fell into one of those traps myself. I thought it was and it really just highlighted to me the need for just more focus on this and more ownership in some ways by financial crime risk functions, building it into your metrics, into how you present out to the board on fraud risk. Are you even incorporating that type of risk into your board reporting, or how you're thinking about your controls around external fraud? It's not something that I know we've got right yet. And so it's an area that I'm now actively focusing on just from a financial crime risk management function perspective.
That's great. And so kind of focusing in on the fact that this panel is around unlocking the power of RegTech. We've touched on some of this already, but really, how can RegTech help financial institutions overcome challenges in processing large volumes of data in order to successfully identify any patterns or anomalies that could suggest financial crime? So James, I know you had some thoughts about this from the sanctions side.
I have, yeah. So, of course, sanctions, payment screening is a huge amount of data, especially if you get into correspondent banking. I mean, sort of having to deal with that is a daunting task. Some of the things that we've used, like NLP, things like that. So, actually, let's take a step back. So, the way we have it is we have the payment messages coming in. Then what we'll do is we have an analytics layer. Okay, so then we'll try and put some analytics on it, trying to sort of identify known issues. We have sort of fuzzy logic exceptions, we call them, ones that we know are going to sort of get through our filter to compensate. And then using NLP allows us to kind of really distill it down. I mean, we lose about 95% of the data through those two layers before it gets to any form of, should we say, rules, sort of what's called field-based monitoring, and then also in manual alerts. But without that, it would not be possible to be commercial in correspondent banking at all.
Jeremy, I know that you have some further insights there.
Yeah, I think that ultimately, whenever you have, especially with sanctions risk, is that you're dealing with a bunch of individuals, companies, and huge lists of data that are ever increasing, and especially when OFAC, for instance, started including blockchain addresses. Well, in theory, you could have since there's multiple hops, and you can create addresses for Bitcoin and Ripple or XRP and ETH, you're essentially able to submit an attack to OFAC by creating fictitious addresses through sanctions. So the list is going to continue to get larger and larger and larger. So I think that ultimately you're going to have something that's layered on top of whatever lists to start filtering out a lot of the noise that can be presented. And unfortunately, it's not like when a new person that's going to end up showing up on the sanctions list, they're not going to have a very unique name. Ultimately, we have the names that we have, and we just need to act better, being able to extract better information, linking it to media. And so you have to have some type of solution in place that extracts all the information that's public, anything that's maybe, we were talking earlier about leveraging new technology apps like Instagram and TikTok and blogs and all that stuff, and being able to unify everything, Glassdoor, and being able to take all that information related to the list, remove a lot of the noise, so that your team can actually focus on what they're supposed to do, which is preventing bad financial transactions.
Shloka, may I make a point?
Sure.
So I mentioned the threat of sanctions evasion, and earlier in 2023, FinCEN and BIS put out a bulletin on the importance of HC industry codes and how we need to be on the alert for dual-use goods and how those dual-use goods can be directed towards Russia. It's really not that easy to just look at HC codes. This is where we need some good technology. You really need to look at HC codes plus the description, the narrative description of what is being, put through your, for example, your trade finance rails. So if we're going to be really effective in helping identify these dual-use goods, it can't just be based on HC codes. So right now our staff have to go through some really bulky manual processes to be on the lookout for these types of red flags, but we really need to have technology that's bringing together some, analytics over the narratives in trade finance documents plus the codes.
And I think, Madhu, maybe you have some points there on data centralization and how to get that holistic overview.
Yeah. I think I just want to touch upon the data centralization piece again. Well, and at Flagger, we think of ourselves as like a data warehouse with like a UI on top specifically. And this thing you mentioned with analytics layer makes a lot of sense, right? I think that's how we approach it. End of the day, you don't really need to physically have a data warehouse or you physically integrate the data. All you need is just access to data, which is not really that hard when you have like even siloed data sources, because end of the day, you still have access to these ones. And if you have like a centralized layer that just needs access to it, right? Like having like physical, warehouses where you actually integrate this is harder, and as Jeremy mentioned, definitely possible. But what we have seen, it's much, much easier to just get access to it and be able to just pull that data into one place. It's just, has been very useful for our customers. And at Flagger, we have a saying like, there's no data like more data. Even for like things like sanctions, where, especially with certain aliases, you get like, I don't know, 800 whatever hits. What we have seen is that when you actually pull in more data, like especially from CRMs, or even like getting, if it's like a business going to their like LinkedIn profile, or getting their business websites, or any of these industry-specific directories, we've been able to reduce like the false positive count significantly, right? Because just sanctions, it's just like you're matching a list, but when you have like added data on top, you can, with a certain amount of accuracy, actually predict if this is the actual person, because you have so much more information on your end as to who this person is. And then, and also you have all these operational data with regards to like how you disposed previous alerts, how you disposed other sanction hits. From what we have seen, like just having this data, it's going to be, has been like really helpful in building out a system that can actually kind of remove the noise away from the analyst, really.
Yeah, can I just add, also, there's two sides of the data sanction screening. So we have a list of bad actors, should we say, or dual-use goods, and those sort of things. And then we have the information on the payment. Now, there's lots of good work that can be done on how we identify that match and identify sort of that payment data. But we shouldn't underestimate the amount of what effort should be put on lobbying people like OFAC and other people to clean up their lists. I think there's a court case at the moment that there's a set of people that they've been on there for 21 to 7 years, and they're no longer seem to be bad actors, but they're still on the list. It's the same thing with these strong aliases. We have an expectation by certain regulators that we should be catching those. Now, some of those strong aliases are junk. I'll be honest with you, 2 letters, 3 letters, those sort of things. That's not useful. So as Mandu mentioned earlier, we reduced our alerts by 800,000 alerts because of one alias got changed. Okay, so that's very important. It's not just the data that we get in from our payment systems; it's the data that the governments are asking us to bounce up against. Because that way we can do the job that they want us to do, which is to sort of protect the economy and to protect from bad actors. So don't underestimate that part.
Thank you. That was fascinating. And so moving on from the data piece, let's sort of really dig into some practical examples and case studies in which you can sort of demonstrate, how has AI been used and leveraged to effectively detect and prevent financial crimes. So I know, Trish, you've got some excellent examples that you wanted to share.
I think the use case has already been made for the use of machine learning in nameless screening and transaction screening. I've been involved in several banks where this is quite a good success story. But I think the reason I'm highlighting it now is the need and the urgency for this is never greater. With the explosion in sanctions, I think in 2023 we're going to over 35,000, sanctioned parties. Our systems, our teams are being weighed down with, the 99.99% false positives. And it's not just about risk management and how our teams operate effectively. It's also about client service, right? Our clients want to get their payments fast. And when my bank is screening the same payment 3 times as it goes from one affiliate to the next, and then I pass it over to your bank and you screen it 3 times, and then it goes ultimately to the Benny Bank, that's a lot of friction. All around false positives, and that's not optimal client service. So while machine learning is great, and there are some amazing vendors, and I'm sure some of them are here at this event, it's also a really siloed approach, right? Where I'm going to spend a fortune implementing the best technology, then you're going to do it. But there's now, really good utilities building. So let's screen it once, let's screen it right to the highest standards. And also, it's really also about financial inclusion. Many banks can afford top-of-the-line technology, but not a lot of players can. So should they be left behind? So we really need to think about putting great technology into the utility model and not just operating in a siloed approach. So machine learning for sanction screening is definitely the way to go. But then something more innovative that we're working on now is actually doing a machine learning data analytics use case on identifying sensitive PEPs. So within our sensitive client unit, we are tagging sensitive PEPs, so really trying to cull out from the thousands of PEPs I'm sure all of you have in your FIs, what is the you know, that echelon at the top that really poses the highest financial crime risk, such that if there was an event with one of these people, it might be a headline event. But how do you make sure, short of every periodic review, drawing them out really quickly? So we put together a machine learning use case based on different attributes to make sure we have sight of every one of these most sensitive PEPs.
And James, anything that you want to share from the Scotia side?
Just one thing. We use AI and machine learning. The two ends of the spectrum. We use one is the noise reduction, right? That's the sort of the low brain power one, just to get rid of all the noise, which is huge and it makes a massive financial difference. You know, and the effectiveness of the program increases because of that. And then the other side, public-private partnerships. So we do it for human trafficking, wildlife trafficking, those sort of things that are not sort of as easy to catch with sort of the regular rules or models that we have, and allowing the sort of AI to sort of have its own time, not necessarily in a, hey, you've got 30 days to disposition this type thing, or 60, 90 days, depending on, you know, it's more about having some time with your data to allow it to look for those patterns and spend more time looking for those more sort of unique typologies, and especially where, you know, for the bank, we're very strong on, you know, anti-human trafficking. And for me personally, that's one of the main things. If I see a victim at the other end, that matters to me. Okay, I'm a parent. If it's anything to do with children, not, you know, that's where I want to spend my time. So that's what we're doing. We're allowing technology to spend time with our data to be able to identify those things in the long run, in addition to using it to reduce noise on payment screening and some of the other sort of transaction monitoring work.
That's a good segue into our next question, which is how can collaboration between financial institutions, RegTech, and public bodies help tackle financial crime? So James, I don't know if you want to speak further on some of those public-private partnerships.
I will. I think Patricia and I were talking about the same thing. So there's this idea of doing it once, and I think that's a really good idea. And there's this, you know, sort of GSS. This is this global sanctions screening. This is where you get all these banks together. It's such a smart way of doing it. Now, the hurdles historically to utilities has been regulatory agreement. Okay, there's lots of issues with some of the KYC utilities with the MAS and other folks that like the idea of it, but it didn't really stick. Okay, now currently we've got some very good traction, and I know that Deutsche Bank and also Scotiabank are involved in this. They got the Treasury to agree to some of this work, and that is a huge leap forward. That means that we can sort of just check once rather than, you know, sort of hit it 50 different times. It improves the customer experience. It means that we can concentrate resources, pool resources to actually catch the bad actors and stop it. And I think overall it's a really good idea. Also, public-private partnerships, or even just private partnerships. You know, one of the big things that we like to do is get all the banks around the table. I always challenge consulting firms. Can we do a round table on X or Y? Okay, then we get folks together, and then we actually sort of work together on what's the best way to do it, to share information without having to share customer information, sharing best practices. So for the first time in Canadian history, after the Westpac, we got all of the CAMLOs, those are the chief AML officers in Canada, around one table. And it was basically saying, and again, I was very animated in this, that we're all parents, we've all got kids, let's do something to stop this. This shouldn't be our day job. This is, I prefer to do this for free. We want to stop the, you know, sort of people, these victims being hurt. And so then we got together, we shared ideas, shared about how we sort of, you know, payments to the Philippines or the credit card things, if you've got VPN on your, you know, that you've been purchasing, as well as storage lockers, those sort of tidbits that we came together. And there is material improvement in protecting our sort of the community we do business in. So that is something I'm very, very proud of.
Madhu, you know, from the RegTech side, what are your views on that?
Yeah, I think one of the things that's often overlooked is just, you know, beyond what's already been said, is just sharing the insight from the operational data, right? From what we've seen, like, you know, Flagger operates in all 6 continents. So for context, from our experience, like we would see like a new typology, a new kind of fraud ring, hit like, for example, Philippines first, and then just progress its way to like Western Europe and then in the States. And then what we're able to do, and it was like the same typology, right? Maybe different thresholds, different currencies, different like orders of magnitude in how much money was like hit, for example. But you know, but we could see it across customers that, hey, we saw this like last month somewhere else or with some other customer. And what we were able to do is just use that operational data, right, to kind of like provide rule recommendations based on what's actually working, right? And The current like traditional way of doing it is like you just like backtest like a rule or something, and there's only so much you can backtest. Most of it just sample a small part of data. It's not really a good, it really depends on what you sample, really, right? It's never covers everything, and it's always better to, for us, we always found it better to just like take what's already working elsewhere, and find like a programmatic way to find best practices, and then come up with recommendations to do that. And there's no reason why it should be like one organization doing that or anything as such, and there could be like a consortium or like some sort of like an open data exchange where you could just like derive insights from operational data, because now you have like the silos within organizations, but you have so many organizations with all these rich insights that could just benefit the whole ecosystem as a whole, and now they're just, it's just sitting there that, nobody's doing, there's not much being done on it, so yeah.
And I know, Jeremy, you wanted to speak a little bit about regulatory updates and sort of how that gets managed.
Yeah, well, one thing to also mention is that if you have, I would put more of the pressure on the policy making side of things. And the reason why is I think they're the ones who are actually pushing the legislation through, and they're the ones who are providing the enforcement actions that you all love. And I think it's really up to them to improve the data that they have. I think that when you look at OFAC's website, and if you're a junior analyst trying to understand what type of data is on their website and what kind of sanctions are enforced and whether or not your company has applicability to it, it's very hard to understand. And I think so. From their side, I think they need to simplify it. They need to get better data. They need to improve name screening so that actual FIs can actually utilize what's on there. The other things to mention on a regulatory front is there are certain countries that have gone through their court system to say whether or not AI and ML is a appropriate approach. In the United States, I think we always like to see what others are going to do before we end up doing something. Our judicial system and legislative systems are purposely slow for that purpose. But in the Netherlands, with the highest court in the Bunk case that they presented, that they are able to use AI and ML to do a lot of their AML-based work for them. And how it's going to be introduced across Europe and then possibly bleed into the United States and Canada, it's yet to be seen. I think that with AMLIN 2020, FinCEN has definitely introduced the fact that FI should start looking at technologies. It shouldn't be their sole focus. There's still the 5 pillars, but ultimately you need to start thinking a little bit more forward. There's fraud and money laundering is always going to happen. It's just going to take a new form, new way of doing things, and it's not like transactions are decreasing. We see that across the globe, that transactions continue to increase and budgets are typically making it smaller. So you have to be smarter when you're approaching this subject.
Can I add one thing? We've got a little bit of time.
A little.
We're okay. I'll be quick. The other thing, sort of building on what Jeremy was saying, is that we're experiencing that the regulators are using technology. Okay, so there are in the Caribbean, folks that are say on the grey list or the blacklist with FATF. They're coming up to their evaluation. One of the things they get evaluated on is enforcement and supervision. And so very smart vendors, and I won't call them out, but we've had them come into us, have basically sold them tools to bounce data up against our systems, to benchmark us against our peers, both in sanctions, but also in transaction monitoring. So now you're seeing that it's not just the banks that are investing in technology, but the regulators are as well. And the thing that I'll finish on is that there is new tools, and my friend Jason at one of the vendors told me last night about this, where they try and test your system. Same thing as what the regulators are doing, but you can buy that tool yourself to see how well your system's doing. It tries to get around your controls, tries to launder money through you, or take fraudulent action. And it's a good way of basically doing a bit of an acid test, a dip test on your system to whether it's good or bad. Now, the one thing that you will also be talking about probably in a few years will be the counter to that. So we have AI coming and potentially attacking, or being used as a tool to attack an institution if it's trained on the right domain. You're also going to have tools that are going to be trying to detect that. So we're seeing that now in college where people are basically writing articles and then I think there's JATTTB 0 it's called, which is there to try and, counter that and highlight where there is AI being used against, or to produce an article or a piece of dissertation. We're going to be seeing that at banks as well. That means that software currency is going to be a key thing to be able to sort of invest in. Make sure that we're not only just keeping pace with the technology that's out there, but we're actually trying to keep in front of it. Because soon as they find a crack, and Jeremy, you said this at the beginning about soon as someone finds a crack in your system, they just plow it through to get as much sort of out of you as possible before you close that gap. So it's essential. So it's a really important thing to be mindful of. Sorry about that.
No, that's quite right. Trish, any final thoughts on that you wanted to add in?
I think when we can combine the power of public-private partnerships with great technology, that really will make a difference in fighting financial crime. I can't say more about the use case for GSS as well. I'm not paid to say this, but not every process for financial crime lends itself to a utility model, but transaction screening may just be that one.
Excellent. So with that, we will launch into the Q&A session. I don't know first if we want to check if anyone in person in the audience. Ooh, I see we have a few questions there. Mike, coming over to you.
I have one question is, how are you all trying to encounter exposure of AML risk in terms of cryptocurrencies? I mean, I just wanted to see what's your experience and how are you dealing with that?
Do you want to go first?
You start.
I start. Oh, here we go. So there's a couple of things. First thing is we are putting up the walls around ourselves to say we don't really want to touch it. So until we understand it and we have technology to be able to handle it and the controls in place, whenever we touch, say, a payment processor, one of the questions I ask them is, what's your exposure to crypto? If we're talking about online gambling, which is now becoming less and less scary, should we say, right, is there a crypto element to it? Can an exchange be, touching you? Are there wallets? We will not touch it until we understand it is the safest thing we're doing at the moment, okay? Now, the other piece is we do look for, in our payments, any indication that there's some form of exchange involved, if there's money going to or from it. A lot of banks prohibited, credit cards and debit cards being used at those exchanges. We've changed that. We used to do that. Now we're opening up a little bit, but we're very discerning on which exchanges we're okay with. But we are not processing crypto. It was literally just the entry, exit, and sort of on-ramp and off-ramp from fiat. That's the part we're doing, and we're very hesitant and conservative in our approach.
Absolutely agree with all that. Definitely, it starts with your risk appetite across all domains. How do you want your own staff to engage with virtual currency? How do you look at source of wealth for your clients when it comes to virtual currency? How do you, as an institution, want to offer virtual currency as a product? But then, probably really importantly, if you're a correspondent bank, how are you looking at downstream clearing for virtual asset service providers? So, almost a year ago now, Wolfsburg updated its correspondent banking due diligence guidance and expanded the definition of downstream correspondent banking from just banks to all FIs. So now we have regulators very much looking at what are your controls in place to monitor for downstream clearing, not just from banks, but from all FIs. So that's something to be aware of, where you're providing services to other banks, and how are they exposing your product to potentially virtual asset service providers.
If I may add, I think one of the things with crypto right now is just lack of clarity in the regulatory regime, right? Like there are cases going on with SEC, like some people are, it's security, it's a token, it's a collectible, so there's no clear judgment on what regulation will look like or what it even is going to be classified as yet, which makes sense that banks are more hesitant because there's no clear regulatory path to deal with that. But from what we have seen with specifically crypto companies is that most of them are trying to at least adhere to some sort of regulation, right? To just adopt themselves to say, hey, at least, hey, when the regulation does come, if it does, that they already have some controls in place. And beyond banks, there's also banking and service providers, some more regional banks who have the kind of risk appetite that would onboard crypto businesses and work with them. It also makes it easier for them to get onboarded if they already have controls which are similar to the controls that a bank or a BAS might have. But I think until the regulatory regime is there's some certainty there, there's always going to be kind of volatility in how they deal with this kind of compliance risk.
And one last thing to mention is removing the regulatory side of things is just dealing with the transaction monitoring. I think the blockchain, if we're just looking at Bitcoin, I think there are certain vendors that already provide a really great solution, and ultimately, you know, a unified way of doing transactions, the GSS. If you look at that as just transaction, that a Bitcoin address could be flagged from inception, that person was sanctioned or a fraudster or whatever, and you're able to follow money trail from that person to the original address to follow-up addresses. I think that's a really great way of doing financial detection. You just have to have the people that are proficient enough to utilize the tools. The Canadian regulatory regime has been very strict on crypto companies and a lot of P2Ps, and that's why they want to focus on traditional banking. But if you do have other continents and countries that are wanting to participate, take the possible risk associated with regulatory challenges and so on, and just look at it as a payment mechanism, then I think that you just need to have the solutions in place. You have to understand your risk associated with blockchain-based payments and acknowledge them as just possibly look at them as possible cash transactions or wire transactions that are typically viewed as higher risk.
Are they higher risk though? I always think of it's like cash with fingerprints on it. It's all, you always know who's got it. Yeah. I mean, I think it's a bit of a fallacy that people say crypto's the scary thing, because realistically, if it's associated with blockchain, you know who's touched it, when they've touched it, where it's gone. And really, if you look at all the large cases that have involved it, it basically has some poor person that's basically been convinced to be the person that's going to put their name to being the on-ramp or off-ramp, like the poor guy that was in, I think it was in the Philippines. So, you know, in a way, it's almost like this, there's this concept that it's a lot scarier than it is, because people didn't really understand it. You know, and also, you know, most of the times that there's any, what's it called, ransomware, there's always a step that has crypto in it, always. And I'm not entirely sure why, because again, it's like cash with fingerprints in my point. So.
All right. A few more questions in the audience.
Thank you. First of all, I'd like to thank the panelists. This has been a fascinating discussion. There was a point being made in the first panel about there being a lot of new RegTechs on the market. And I think a quick glance at the screen behind the panelists will confirm that assertion. And we're looking to, so we work with a lot of the large institutional clients to try to determine what the right tools are and how they can solve some of these use cases. And we've come across with many of these conversations, one of the major issues is the reluctance to share the data with the external provider. We see that many of these newer RegTechs use cloud-based solutions, and there are certain there's certain functionality that you can only get when you use a cloud solution, but then you have to kind of overcome that hurdle of being able to share that data and being secure in knowing that your data is being handled the right way. So I'm wondering, what is your strategy and where do you see yourself on the roadmap to be able to use that functionality?
Do you want me to go first? So for us, there's a couple of things. So there are hurdles that are out there, regulators, okay? So we're in 33 countries, and there's at least 6 that say you can't really take it out of the country, okay? And that's frustrating for us because we want to centralize controls. Now, okay, things like SWIFT, that automatically is already outside of sort of, you know, the jurisdiction, but there's customer information is the real problem, like PII. That's where, yes, you can get comfortable with the vendor, you say, right, you've done all the like third-party risk management piece, we understand that all the controls around it, you tokenize it, all those things, but there are some regulatory jurisdictions that just say, we don't care. We're not comfortable with it. You cannot take it out. And so that's a bit of a problem. We are wanting to move to, you know, sort of applications as a service or something, you know, sort of be able to have cloud and all those different things and be able to leverage it. But there needs to be some regulatory catch-up, to be honest. And we're not even, some institutions, I won't say Scotia's there, but some institutions find it very difficult to be able to bifurcate what they can and can't move around. Okay, and then it's very difficult. So a lot of the time, it's a lot safer just to build it in-house. I hate it. It's a lot more expensive to have to build stuff, like to get a vendor to come in and build it on site versus actually, you know, be able to kind of take it off. It's not as nimble, it's labor intensive, and it's expensive. So, you know, we do a lot of lobbying in that sense, but where we can, we are doing that. And again, it's about trust, and it's about making sure that you can do things to anonymize the data and things like that, which helps, you know, sort of hugely in some areas. And some of the data, like I said, like certain parts of like Mexico, we can't do it, just can't.
Same. I mean, we're operating in multiple privacy jurisdictions and, you know, complying with GDPR, and data privacy is one of the biggest challenges. But then I'd also say another big challenge is just, you never purchase anything off the shelf. You need a lot of internal people working on the project. And it's not always easy to do that, right, with other projects going on internally. So we always have to do that impact assessment when we're thinking about new technology, not only the data privacy challenges and where we can roll out and can't roll out, but do we actually have the people on the ground that will be able to support an effective implementation, or else it's just money not well spent.
So these free POCs, everyone throws free POCs at banks. Well, they're not free because I need someone in-house that I'm paying to actually sort of support it and actually facilitate it. So it's very frustrating because I see all these kind of like carrots being dangled, but we can't take advantage of them. And so that's one of the issues. Nothing's ever really free at the bank.
And to add a point from the vendor side, I think many of the data concerns you brought up, I think they're very valid. This is very sensitive information. There's like legal obligations. People, potentially might go to jail. Like, these things have happened before. So yeah, I think it's very valid, right? And from the vendor side, I think it's very critical to have like really good data infrastructure and like very good security systems. Of course, there's certifications for that, and which we feel like like SOC 2 and other things like while they keep you secure, from our own experience, I don't think it's like as tight as it needs to be. And vendors should take it upon themselves to kind of like make it even like as tight as it can be in terms of like security. But when it comes to like the data, localization, like some jurisdictions of course have this. Even Europe, you need the data to be within the EU. I think that's one of the actually advantages of cloud, because we do have like customers who are expanding to newer geographies. It's much easier to just get started in a new region, a cloud provider, right? Like AWS, GCP, Azure, for example, have 30, 40 like availability zones. It's much easier to just get a local data center, spin your instance up there, as opposed to like just provisioning like some HP instances and getting people in and trying to set that up. And one last thing is, I think from what we've seen, we do have like larger companies, right, larger financial institutions slowly embracing cloud, but not full cloud, more like a hybrid. And that's something that we've been working a lot towards, to enable this kind of hybrid cloud, and more importantly, to be able to deploy into the account of financial institution where they kind of own all the data inside their account, as opposed to an external party guarding their data as such, which again, will lead to more concerns.
Jeremy, anything you want to add there? All right. Well, I think with that, I'll kind of leave it to the panel if anyone has any final thoughts or anything else that they wanted to end with. All right.
Don't look at me.
Well, then I will thank you. I have learned a great deal. I think this has been a sort of a wealth of expertise shared over the course of this 45 minutes. And thank you so much to our audience. Some great questions. I hope that you have learned as well. And thank you so much.
Thank you.